This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. Last week, we had a guest podcast with Richard Hill of Principal Asset Management. So we have 2 weeks of data and news to cover. Let's dive right in. Since our last market update, there's been good news and bad news. On the positive side, the Consumer Price Index came in lower than expected, and the latest U.S. jobs number came in above expectations. Treasury yields declined, with the yield on the 10-year hovering just over 4%. On the negative side, the market saw big sell-offs from U.S. brokerage stocks, shares of PE firms, and U.S. software stocks. Investors rotated out of tech stocks and big names considered vulnerable to AI shocks, and U.S. GDP came in well below expectations. Manus, where are we? Is the glass half full or half empty?
I think you have to separate that question into two parts, one that applies to the broader U.S. economy and one that applies to CRE. And there is a lot to dig into. It's been a while since we've really walked through all of this. And let's take it from the top. Let's start with the broader U.S. markets. I don't think the U.S. is out of the woods at all, even with some very positive economic reports. Certainly, the markets cheered the lower than expected CPI number. There's probably some cheering going on when the Supreme Court came out and said the tariffs were unconstitutional. There was also plenty of backslapping when the jobs number came in above expectations. Now, to be sure, nobody's really happy when job creation is stuck in that 130,000 number per month and that we have negative resets all the time. We want to see 250K, 300K job creation to really buoy a growing economy. 130,000 is kind of middling, but those were positive data points. But on the other side of the coin, there's a lot of reasons to be cautious. Home builder sentiment is still in Dante's sixth ring of hell, and consumer confidence is only a rung or two higher. So there's a lot of reasons to really be cautious here. Beyond that, there have been heightened worries that PE firms are sitting on a boatload of bad loans and that their unregulated exposure could lead to systemic risk. I am not at all there that the PE problems will metastasize and will become systemic. But certainly there are some that believe it will. We saw shares of KKR and Ares sell off sharply last week. So I am in the camp of, at least for the broader U.S. economy, we're going to see some turbulence in the next 6 months. I think that stocks are back to near all-time highs. I do think that this is happening even though we've seen some real sell-offs among the Magnificent Seven, among software stocks. This is being supported by kind of the bottom of the barrel type stocks. People are rotating out of tech into things like utilities, stodgy old oil companies, consumer staples, things like that. And I shouldn't say bottom of the barrel. I should say stodgier. That's a better word for it. But that's only sustainable for so long. So I think I'm very concerned that right now the markets are frothy, and at least for the broader U.S. economy, there's one or two more legs down and more turbulence before things get better.
Yeah, you pointed out notable soft spots there, Manus. First of all, let me thank you for a truly great episode with Richard Hill last week. If any of our listeners missed it, be sure to tune in. I thought it was interesting how Richard flipped several narratives, including the narrative around the wall of maturities. You know, he doesn't see it as an imminent systemic threat, but kind of more of a slow grind, and some good news for anybody looking for optimism in the Midwest markets. So kudos to you, Manus. That was a really, really great episode.
It really was a fun one. And one thing that he pointed out, and I can't remember if it was on the episode itself or if it was in our conversation before or after, he pointed this out, that the people that went through the great financial crisis are now 38 or older, right? It's been almost 20 years since the great financial crisis hit us. It's been about 18 years. So if you do the math, you have to be 38 or older to have been in the professional markets when this started to unravel. And his point was that there are so many people that don't really know what terror looks like, and they're assuming they know, and they see things like PE shares selling off. They see headlines about PE firms having lost their way, having not been very disciplined in their lending, things like that. And similarly with the wall of maturities, they see that, and their first instinct, having not lived through it, might be the sky is falling. But for guys like you and I, Dianne, Richard, other people that were through it, we know what bad lending hygiene looks like. We know what excessive risk looks like. We know that the nuttiness of that period, the minuscule returns people were getting for taking on enormous risks, the puny levels of equity people were putting into deals, the assumptions they were making on future performance of the markets, all of that was crazy. We're not at crazy right now, and thank goodness.
That's why they say that it's the wisdom that comes with age, right, Manus? So, on your comments just now about the broader market, I do still remain concerned about the labor market. I think if you're only looking at the headlines, you're maybe feeling okay that unemployment is low. And like you just said earlier, January added jobs, but they did it at a pace that's well below the 250 to 300K job level that we typically associate with a strong economy. And, I'll go even a step further and add that if you looked at last year after the latest revisions, 2025 only added about 180,000 jobs total, and that's barely 15,000 a month. So outside of a recession, that's the weakest job growth that we've seen in our economy in more than 2 decades. And then even more concerning on the glass half empty side, nearly all of the recent job growth came from where? It came from healthcare. So if you strip that out, our employment growth is basically flat. And the industries that drive commercial real estate demand, like office using sectors, manufacturing, logistics, they're not hiring in any significant way now. So I do note the fragility that you just ran through in the equities market as investors rotate into what they see as what you called stodgy buys, the safer ones like utilities and consumer staples. But, any bearishness I'm feeling at this end on the broader economy is because we're just not seeing the labor market expand in the way that commercial real estate needs it to.
Yeah, I'm concerned that the frothy levels we're seeing in equities, and maybe I'm beating a very tired drum here because I've been saying it since July. I think the frothiness is a bit of a mirage, and it's more of a mirage now than it was at any time in the last 9 months. So let me talk about that a little bit. Barron's did a great piece 2 or 3 weeks ago when they talked about the unraveling of the tech bubble around 2000. For those that are even older than 38 that may have missed out on the tech implosion from about 1997 to early 2000, we saw a run up in internet stocks that was through the roof. People were paying extraordinary multiples for companies that had no cash flow yet. They had a dollar and a dream, and they were expecting to throw up a website like beer.com and come up with 10 million viewers and ad revenue and so forth, and would have unicorn valuations in no time. And then Barron's came out with a piece around that time which said these companies are burning cash so fast that many of them will go bankrupt within 6 months. And the bubble popped. And for a short period of time, people raced out of tech stocks and raced into these stodgy consumer staples. So we saw margin collapse on the tech side, but we saw multiple expansion on the stodgy side. And for a while, that kept the indices elevated, as Barron's pointed out about 2 weeks ago. But it only was sustained for so long. And eventually, even that bubble burst. People said, we can't be paying 20 times earnings for a stodgy old company. And that's what's happening right now. People are racing out of Salesforce. They're racing out of some of these companies like IBM that they think are threatened by AI. And they're racing into consumer staples. They're racing into utilities. And those multiples have expanded dramatically. And I don't think that's sustainable. I think one of these days there will be a reckoning. I don't think it's a 40% sell-off reckoning, but I do think that there'll be a reset. And that reset will be, people say, okay, the AI trade will have some casualties. Those companies that we valued highly in the past should not be valued like they were, like IBM. But the AI companies, the winners themselves, will take a long time to make money. And in the meantime, we don't want to pay 21 times earnings for a stodgy company. So I think some kind of a reckoning is coming. When, I don't know, but I do think the next 6 months will be turbulent for the U.S. economy and for the equity markets.
I think you might be right, Manus, and I will interject there that I've been watching you on LinkedIn, and I think you're developing quite a following with stock picks. So you could be the next Jim Cramer.
One thing I always fear is that I don't want people to follow my advice in either betting on sports teams, because I always lead with my heart there with my beloved Giants and Rangers, or the stock picks too. I don't want to be responsible for other people's, monthly paycheck. So I have to be careful there. And certainly, like fishermen, I like to tout my winners and ignore my losers, right? I like to tell a good fish story, but I do believe that those brokers were good buys a couple weeks ago when they sagged 25%.
Yeah, interesting currents taking place in the equities market for sure. But let's turn to commercial real estate and let's hear what you have to say about the bear case versus the bull case.
So for those that have not been following us on LinkedIn, Dianne and I both put out now weekly commentary that we post on LinkedIn that gives our thoughts about anything and everything about the economy, about CRE. We've been doing it for about a month. I think they've been fairly well received. We get plenty of feedback and comments and reposts and stuff like that. It's a nice thing. But let me roll out my last two. One which talked about a potential bear case for CRE. And then this week, one that talked about a potential Goldilocks case. So let's talk about the bear case. Can the private lending tumult spill over to the CRE markets? That was my question 2 weeks ago. Said another way, can the entire CRE market be dragged down by the PE corporate lending morass, collapse, loan losses, et cetera? Should there be one? Should that come to pass? And the answer is maybe. If the narrative continues that PE firms have lost their way, that they're sitting on massive losses, spreads on small corporate loans will continue to blow out. Should predictable widening turn into a rout? Should loans be marked down 10 or 20% of face value? Banks would require more collateral. They'd pull warehouse lines. Liquidity would vanish. Spreads would widen even more. If you believe that PE losses become systemic, spreading to bank loans, liquidity would seize up even more. And if that happens, the CRE market would not be immune to pain. Some of that liquidity tightening would find its way into CRE. And because markets keep a certain contour, because spreads kind of parallel each other between the corporate lending market, the leverage loan market, the residential market, the ABS market, the CMBS market, because they keep certain parallels, any significant widening in the corporate loan market would have gravitational pull, and it would pull CRE spreads wider. We saw this in 2015 and 16 when people were predicting huge corporate losses on loans to oil and gas companies when oil fell from $100 a barrel to under $40 a barrel. And we saw enormous spread widening in the corporate loan market. Losses were expected. They didn't really come to pass, but they dragged CRE spreads wider. Volatility spiked, and the CRE lending market, particularly CMBS, shut down for about 4 months. Lenders couldn't lend confidently knowing that they could securitize loans. Now, could that happen here? Yes. Is it my baseline scenario? No, I don't think that we see that kind of systemic risk, but it's not out of the question. So let me pause there, Dianne. I've given the bear case. Let me get your thoughts on that.
I think you framed it well, Manus, and I think what it comes down to is really the containment issue, which I know you and Richard discussed a lot last week. I think on the bear case, it's about liquidity and it's about containment. And if private equity volatility, as you said, spills into broader credit markets, then yes, we'll see spreads widen fast. And then what happens? We see refinancings get difficult overnight. We see valuations come under pressure. And then the lending and the deal flow that I think everybody has baked into some pretty optimistic forecasts for this year start to stall. The Mortgage Bankers Association just came out with their forecast for 2026 lending, and they're forecasting an increase of 27% over last year. So if that bear case plays out, which I don't think it will, they'll have to downgrade that 27%, I think, a little bit. But my money right now is on the bullish scenario. I do think that any damage will be contained and commercial real estate will stay in favor.
And the bull case itself could become a Goldilocks case. And I laid that out this week in our thoughts. I noted that pearl clutching in the PE markets could lead to a real sweet spot among CRE. So let's walk that through. The Goldilocks scenario over the next several months looks like this. PE and corporate loan angst lingers, but it doesn't spread to other fixed income areas. There is no contagion. The damage remains strictly with PE. The threat of spillover keeps markets cautious, pushing Treasury yields down continuously. That we see the yield on the 10-year fall from what it's about 4.04% today, which is about 10 basis points lower than before the PE tumult. So picture this going down to 380. As people say, there's problems there. We have to be dovish as a Fed. We got to make sure that this doesn't spread. So you see this march lower in interest rates. Lingering concerns drives another lowering of interest rates at the short end and the long end, so that 404 becomes 380 for the 10-year, indicative of caution but not panic. And I think what we've seen in the residential side is when the yield on mortgages, or I should say the rate on new mortgages, drops below 6%, people race into the market. They want to refinance. And I think we'd see the same thing here in the CRE market. If we saw a 380 10-year Treasury without meaningful spread widening, I think we would see a deluge of both refinancings, people trying to lock in lower rates while the getting was good. And I think that we would see an uptick in sales velocity. For buyers, they would say, rates are coming down, let's jump before they fall further. And sellers would say, we've seen the firming up of prices that we were hoping for, let's move these assets now. So my gut says this: rather than PE market volatility becoming contagious, the PE pearl clutching drives interest rates lower, and CRE, as a result, hits a real sweet spot.
I hope you're right. I like that scenario better. And it certainly seems more realistic. I think all eyes are on the 10-year. And if that goes down another, 10 to 25, that's going to be a big tailwind in terms of both refis as well as new originations and new deal making. So that's where my money is.
Dianne, let's transition to the Lightbox data dive for this week. What do you have for us?
Thanks, Alyssa. I think this conversation, Manus, is a perfect segue to what the latest monthly CRE activity index told us about how 2026 shaped up out of the gate. Historically, January does deliver a strong rebound in the Lightbox Commercial Real Estate Activity Index, and 2026 definitely followed that pattern. The index jumped 28% in January to 110.7, up from December's 86.7, as the market regained momentum after its typical year-end slowdown, and the reading marked the first return to triple digits that we've seen since October. And it came in above 88.2 1 year ago. So all of the improving market conditions that we've talked about, despite the labor market softness, despite what we're seeing in the equities market, and the expected Fed pause on rate cuts that we saw in January, all of those soft spots in the broader economy didn't really have any impact on the index, at least in January. So, if we start to see soft labor data, concerns in the equities market, if confidence and sentiment start to slip and impact commercial real estate, we should see it in the index first, given that the index is a measure of three things. Are properties still coming to market? Are lenders still demanding commercial appraisals? And are investors and lenders having environmental due diligence conducted pre-closing? So far, so good. And believe it or not, we're in the final week of February, so we'll have the next round of results very soon.
I thought that was a great summary, by the way, but also a great number. I was concerned a little bit about the January number. Those jobs concerns were real. And let's not forget that the private equity concerns, the lack of lending discipline concerns did not emerge last week. They really emerged in November and December. Jamie Dimon with his cockroaches comment, the bankruptcies of Tricolor and First Brands. So if people were getting concerned, that concern would have started in November and December, and I think would have been reflected to some degree in those January numbers, but they weren't. And I think that's a terrific sign that, as with April and tariffs, people are still for now looking at these as two different markets, that CRE is one thing. It has held its discipline. People have not lost their way. It's a completely different market, and maybe a safe market, a safe harbor in these times of tumult versus the PE market.
Hear, hear.
Dianne, how about our Did You Know for the week?
Well, Alyssa, for the Did You Know, we'll look at the preliminary January transaction tracker numbers, which, they really reinforce what the activity index already told us. And that is that the momentum that we just talked about carried into the first month of the year. So after a year-end surge of 199 deals over 50 million in December, January still posted another 145 transactions above 50 million. And it wasn't really a drop off. It was sustained activity. So in total, Manus's group tracked deals amounting to 1,163 closings at a total of 24.1 billion. And that was compared to December's 32.9 billion. So yes, December was higher, and we certainly saw a surge in the final week or two of the year. But January's volume remains solidly in line with a healthy market. So between the rebound in the activity index and the strength in larger ticket transactions that Manus's team is tracking, I think our latest monthly data doesn't point to an early year slowdown. It points to momentum.
And I want to scratch beneath the surface there just a little bit to tout our team that does collect this data and point out a difference in methodology between us and others. I know that some people that put out numbers pointed to a December slowdown, and I believe that's because many other entities that track this data focus on public filings. They wait until public records show a deal being closed. We really try to lean in on things like announced deals. Even though something's announced in November by a REIT, it may not close until February. We try to track press releases and so forth. So I do think, like with our appraisal data, like with our environmental data, this data is a much more leading indicator than perhaps some other indices that track this. And kudos to the team that make Dianne and Alyssa and I look good every week. We really appreciate their leaning in and collecting this data so doggedly.
Yeah, it's a lot of grunt work. And I'll add to that, Manus, that typically what I just covered are the preliminary January numbers. And typically when I get the next round, that number will go up as your team uncovers even more. So a strong January will be stronger as we get the final numbers in. Back to you, Alyssa.
Pivoting to our stories for the week making headlines. 2 weeks ago, we had some good news out of San Francisco. Let's start there. Manus?
So the headline 2 weeks ago, we talked about how there had been leasing momentum, AI companies coming in, taking leasing space. But more importantly, we talked about the revival of that Union Square area. We talked about, I believe it was Gucci spending $44 million to buy a property to put a new flagship store there. And we talked about how the turnaround was terrific, that we had gone from 2 years ago everybody talking about how Union Square was unvisitable, that the risks of smash and grab were everywhere, that the quality of life issues were plentiful. And now what we saw 2 weeks ago was that Gucci headline. And now this week from the San Francisco Business Chronicle, Roland Lee, his headline, San Francisco's Union Square hums back to life. The return of AT&T and the Real stores, retailers set to reopen space that was shuttered in 2023. So I wanted to start there because it was underscoring the point that we made 2 weeks ago, that, and it's a real positive one, and it's easy to forget this, that narratives can linger for a long time, that a city can be stigmatized by a narrative that says quality of life is bad, but it doesn't last forever, that cities do come back, that if leaders take the right steps to make it safe, to clean things up, to make it favorable for business, that things do come back. And it's great to see San Francisco coming back as quickly as it is. And I'll come to another comeback story here. I'll pivot over to Chicago. This one coming from Ryan Ori of CoStar. Gap eyes a Magnificent Mile comeback with an 8,000 square foot lease in Chicago in the Magnificent Mile area. The retailer is in negotiations with Ashkenazi and Aurora Capital to take 8,000 square feet at 700 North Michigan Avenue. So just as with San Francisco, not long ago, Chicago was talked about dangerous smash and grabs, quality of life issues. And here we have another retailer, in this case, the Gap, taking the plunge on a city that is trying to turn the corner. What do you think, Dianne?
You know, it's interesting, Manus, as I listen to you talk, it brings to mind an adjective that you coined a couple weeks back when you were talking about the KER recovery, referring to what we're seeing as these kind of high spends by consumers in the high income brackets, and then more caution by lower income consumers. And, you know, as I listen to you talk about these two leasing stories about retail revitalization, they just kind of struck me as that same kind of two-speed consumer economy, because both of these are in prime retail corridors. Both attract more affluent shoppers, but as well as brands like Gap and AT&T and Uniqlo that serve more of kind of a middle income customer base. And I think both are signs. Yes, it's great to see big leases by major retailers returning to areas like this in San Francisco or the Magnificent Mile in Chicago, that they're reopening in districts with strong demographics at both ends of the spending spectrum. So a very positive sign, and one that hopefully will attract other retailers to do the same.
Are you suggesting, Dianne, if I heard this correctly, that you'd feel better if we saw both Gucci and Dollar General in the Union Square market, that it wouldn't be as KER as it's been?
That might be the winning ticket if a retailer wants to appeal to both ends of the spectrum.
That would be a first, I would say, a Dollar General or a Family Dollar on the Magnificent Mile. We will not hold our breath on that one. Let's just say that. Those rents are in the stratosphere for those types of spaces. I want to pivot back to leasing, but not in the retail side of things. I want to conclude this particular segment with two more stories from the Bay Area. The first one coming from Asia Martin of the Silicon Valley Business Journal. Databricks has leased an additional 180,000 square feet in Sunnyvale. This brings their total footprint in that area to over 600K. So again, another story of leasing growth in the Bay Area. It's been going on for about 6 months since AI really started to take off last year. So another one there. In San Francisco proper, Dropbox is going to vacate its headquarters at 1800 Owen Street in Mission Bay. That story coming from Sarah Clearman of the San Francisco Business Times. You would think that that's a glass half empty story, but it isn't really. OpenAI will take that space on a sublet, which shows, again, more strength in the AI leasing velocity, especially in New York and in San Francisco. So a couple of good stories for the Bay Area, following up on some positive remarks 2 weeks ago.
Yeah, those two leases taken together are interesting because at one end you have this AI company absorbing space in a meaningful way. And we're seeing that time and again because of massive funding rounds, because of IPO ambition. Meanwhile, you have legacy tech like Dropbox exiting what was once the largest office lease in San Francisco history. But as you noted, that space isn't going dark, it's being backfilled. So OpenAI is the driver, and these leases are just shuffling around from old to new.
Well, you remember, Diane, the decade before this one was a terrific one for so many cities, everywhere from Austin to Seattle to Pittsburgh near the tech center there by Carnegie Mellon to the Triangle region with tech firms, Amazon, Google, Microsoft, et cetera, taking huge swaths of space, hundreds of thousands of square feet at a time. And that led to just a terrific decade for those cities for the office segment. Let's keep our fingers crossed that this AI seedling that we're seeing in New York and San Francisco continues and expands to other markets.
Absolutely.
Manus, what stories do you have for us in the hotel sector?
It was kind of a wild week for hotels. We've said this many times over the last year that even though velocity has been accelerating pretty consistently in most segments of the market, even in office, even though the prices are anemic, the number of sales we're seeing in the office space has been pretty substantial over the last year. We're seeing lots of stuff trade. The one part of the market that seems to have been left behind for a long time was the hotel market, that we just don't see that many sales month over month. We see some, but it's not a tremendous number. But this week we saw several that were big ticket items. I'm not sure this is an inflection point, but it's worth noting. The biggest one of all, Host Hotels, sold 2 Four Seasons for a combined $1.1 billion. Host Hotels acquired these assets for $925 million. So a nice uptick for Host Hotels, a nice return on investment there. The 2 properties, one was a Four Seasons in Orlando, and I believe that sold for $700 million. The other Four Seasons in Jackson Hole I think it's $750 million for the Orlando property and $350 million for the Jackson Hole. So real nice sale there. You often don't see 10-figure sales in the hotel segment. Those 2 premium properties trading hands last week. In New York, the Soho Nomo Hotel, this is at 9 Crosby Street. This sold to Dianne Hotels for $121 million. This equates to $460,000 per key. Reporting there by Juliana Cuba of Cranes. Why single this one out? There was a time during COVID where we saw hotels starting to trade for under $300,000 per room, per key, even less for kind of the everyman hotels, the Residence Inns, things like that. Seeing this sale approach $500K per key is a nice reversal of that trend. We're happy to see that. And lastly, I think we talked about this before, the Ritz-Carlton Central Park South. This sold a couple of weeks ago, but we didn't have a sales price. Now we've learned that GenCom paid over $300 million for the asset. That equates to, hold your breath on this one, $1.3 million per key. Just shows the quality of being near Central Park, one of my favorite places on earth.
You're right, Manus. We haven't covered a trio of hotel deals like this in a long time, and these aren't your standard Marriott Courtyard or Hyatt Regency assets. They're 3 solid examples of luxury hospitality in Manhattan and Jackson Hole in Orlando. So we're definitely seeing more and more capital that's deploying at the top of the stack. So there's your vote of confidence in the luxury segment in prime locations.
Manus, what are you seeing on the development front?
So 2 stories here. One is kind of run-of-the-mill. One is a little bit of a unicorn. The run-of-the-mill one, according to Real Estate Business Online, Mill Creek Residential has broken ground on what will be a $145 million development in the Allston area of Boston. The property will have 240 units, typical diversity of studios, 1 bedrooms, 2 bedrooms, 3 bedrooms. Why bring this out? Only to underscore the fact, I try to bring out one of these every week, that capital is still plentiful. People are still putting shovels in the ground. And that, as we talked last week with Richard Hill, liquidity is abundant right now, that people who want to do tricky projects, conversions, or new development are confident putting shovels in the ground, and lenders are confident giving them money. So that was the run-of-the-mill story for this week. The less run-of-the-mill one this week, American Express will build a nearly 2 million square foot global headquarters in Lower Manhattan. This will be at 2 World Trade Center. Silverstein Properties will be the developer. The project should be open by 2031. They're talking about 55 floors with the capacity for 10,000 workers. And why do I call this a unicorn? We live in a world now of work from home. We live in a world now where the financial district has not actually been a really desirable place. People want to be in Midtown near the transit hubs. People certainly are not taking 2 million square feet anywhere, it seems, these days. And yet here we have American Express expressing, to use the term, a vote of confidence that people want to be in Manhattan, they want to be in the financial district, and people will be coming to the office, and they will still be doing so 5 years from now when this property opens. So I love vote of confidence stories, and that's what this is, that American Express doesn't believe AI will eliminate the need for office workers. They don't believe people will work from home in perpetuity, and they see the value of being in the Big Apple, which is really the center of commerce when it comes to finance.
Yeah, Manus, you always say nothing says confidence like putting shovels and cranes in the ground. And both of these development stories, although they're very different, are both votes of confidence. And the American Express story is particularly great to see, given that they're going big. Like, they're basically sending a loud message that they're going all in on Lower Manhattan at a time when people keep questioning office demand. I'll note too that both projects have elements of being designed with advanced energy efficient features, and both are going forward with LEED certification. So I see that as a plus too. And I know LightBox has clients on the environmental side that support that kind of work. And it's great for a property's ROI when they're being designed right from the get-go with energy efficient features.
I don't know about you, Dianne, but I still remember the green American Express card from our youth. And I would have religious arguments with people about the American Express card. If you remember, it was different than a credit card. You had to pay the balance off at the end of every month, and they would charge you a fee every year, which it may sound puny right now. I think it was $25 a year, but I was outraged. I would say, you're telling me I'm spending $25 a year and I can't carry a balance from month to month if I need to? And it was an illogical level of anger that it would give me when my friends would tell me I should get an American Express card.
Yeah, that was the big thing out of college, I remember, because it forced you to pay from month to month to avoid the fees, and it was a good way to build up your credit rating early. I can picture that card perfectly.
Okay, Manus, let's wrap with our Go Privates. What stories are you seeing there?
So by Go Privates, what we are talking about here are acquisitions of REITs by other companies to take public companies back into the private sector. We have 2 of these right now, and I'll put them in context in a moment after I give the headlines. The first one, this comes from Monet Fields White of the Los Angeles Business Journal. Brookfield will pay $1 billion for the Peakstone Realty Trust in an all-cash deal. The portfolio includes traditional IOS, industrial outdoor storage sites. The other headline, Affinius Capital is leading a consortium that will acquire Veris Residential in a $3.4 billion deal. Veris Residential is a multifamily REIT. Why bring these stories up? We bring these stories up because when companies take other companies private, it's because they value the assets that these companies own at a higher level than the public markets are doing. Let me scratch beneath the surface there. So let's suppose that Affinius looked at the various residential assets, which spans about 6,500 units in the Northeast, as well as some land. If they said, we think our numbers add up to a value of 4.2 billion, just to throw out a number, yet they see the REIT itself selling at a market cap of 3.3 billion, they're seeing arbitrage there. They're saying these assets are undervalued. It's time for us to buy this in bulk, take them private, because the equity markets are not seeing the value the same way we are. And that's the trend that we're seeing right now. When you see companies go public, it's when people are saying, we think the public will overpay for these assets. It's time to go public. We think that they will pay a premium to what we are seeing these values come in at the private level. When things are selling at a big discount or a perceived discount, and maybe some of this is because of the PE whirlwind we're seeing, companies come in and say, we can buy this portfolio at a sizable discount to where we see value. So just a thought there, something for people to consider. We may see more of this if we continue to see the PE hurricane weigh on all kinds of valuations, CRE or corporate.
Yeah, it's definitely driving a lot of the 9-digit plus deals that we're tracking with the monthly transaction tracker. And both of these, as you said, are signs that private capital is ready to step in on assets where the public market valuations are lagging, in this case, in industrial and multifamily. So these are great to see, and I do expect that we'll see more of them over time. All right, so Manus, I know that you were in New York this week, so you got a taste of a real blizzard. For those of us in New England, it was the second big one in a couple weeks. So I want to know what your favorite memory was as a kid, getting that 7 a.m. call that school was canceled.
Well, the anxiety leading up to that 7 a.m. call was palpable. You'd wake up at 2 a.m. and 3 a.m. and 4 a.m. and you'd look out the window and you'd be keeping your fingers crossed that the snow was still coming down, that it was adding up. And if there was no call by 7:15, your heart would sink. But as soon as you got that ring at 7:01 or 7:02, you knew that the phone chain was operating, that there was going to be no school. Your heart would almost burst. And that memory is just so vivid for me. But for me, it was always the second part of that was everybody grabbing their sleds, heading over to this golf course in Stony Brook, New York. I think it was called the St. Joseph's Golf Course. Us going down the side of a hill over and over and over again until our thighs burned, until we couldn't even stand anymore. So great memories from, I don't know, years 8 to 12, I would say. Just a complete thrill, I would say. And I have to say, even at my age, I still have that wonderful nostalgia when I hear those guys on TV talking about school closures and predictions of 10 or 12 inches. Even though it doesn't impact me anymore, my heart still races a little bit.
Yeah, see, we didn't get the phone call. We would wake up and race to the TV to watch that ticker of school closings, which would scroll across the bottom of the TV screen, and we would just stare at it until it listed our town under the letter, and then we'd bring our shovels to the woods at the end of the street where there was this shallow waterway that was iced over, and we'd shovel these trails in between the trees. And like you, we'd like skate around and stay outside and until we couldn't feel our fingers anymore. And we just had 3 snow days in a row, but there's no anticipation. Now the kids get text messages on their phone, sometimes the night before, so there's no anticipation that morning. I know we're running late, Alyssa, but can we take a minute to congratulate the U.S. Olympic hockey teams? I was so riveted. I think both the men and women's teams played outstanding final games against Canada. I know you're a hockey guy, Manus, but it was jaw-dropping. Like, I saw one play, I had to watch it 3 times, where our goalie looked like he hit a puck out of the goal with his stick behind his back, like he had eyes on the back of his head. And I can barely ice skate around Rockefeller Center, and they skate and play hockey at the same time while opponents shove them from behind or knock their teeth out. It was unreal. I was so impressed.
It was a great couple of days, first with the women coming up with the come from behind and then overtime victory. And then the U.S., I have to say that the term they use in hockey is that goalie really stood on his head on Sunday morning to come in. It was a thrill. I got to watch it with my son, who's really a hockey guy as well. The cheering in our home was epic at the time. But I'll throw one more thought in here, and that is in 1980, when this happened, it led to a really feel-good period for the U.S. and people coming together to feel good. I hope that the success we've seen, not just with the hockey, but with all our medalists there, leads to a little bit more warmth among our country and feel-good moments like it was Sunday morning.
I agree, 100%.
And with that, we'll close. Thank you to our producers at Brooding Media. Join the Lightbox team every week as they share CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great week.
Let's go.